Welcome to the Capital Compass. I'm Lindsay Malchuk. Today we're digging into the sharp rise of Almonty Industries, a tungsten play that's gone from obscure critical minerals junior to one of the most closely watched names in the Western supply chain realignment. Fresh off shareholder approval to re-domicile to the U.S., Almonty is charging toward production at its flagship Sangdong mine in South Korea, a site set to become the largest tungsten operation outside China. A fresh offtake deal with a U.S. defense contractor has locked in exclusive supplies for missiles, drones, and other strategic applications, adding real weight to Almonty's critical mineral status. APT prices have jumped 25% since February. Investor appetite is surging, and Almonty's latest quarterly results, while still showing red ink, are being positioned as a turning point. Now, to break it all down, we're joined by Matthias Greiffenberger, analyst at GBC AG Research, who just released a report lifting Almonty's price target to $5.50 Canadian. Matthias has been tracking the company's pivot toward vertical integration, geopolitical alignment, and defense sector exposure. So we're going to pressure test that outlook and see how much of the runway is real and how much is just runway lighting. Let's get into it. Welcome back, Matthias. It's been a hot minute since we sat down last. This is quite the report you put out.
Thank you, Lindsay. It's great to be back.
So why don't we start with your increase? You've raised your target price on Almonty to $5.50 Canadian, up from $4.20, largely on the back of rising APT prices and the Sangdong momentum. So my question is, how much of that upside is baked into sentiment versus actual operational de-risking?
Yes, thank you for the question. So the target price increase really reflects a combination of tangible progress and supportive market dynamics. The tungsten price has jumped about 25% in February, which obviously lifts the top line potential. And also Almonty has hit major operational milestones. So the Sangdong mine is essentially construction complete. They've secured final project financing drawdowns, and the commissioning is around the corner. Also, Almonty got a binding offtake agreement with a US defense contractor. So I'd say the upside is rooted in fundamentals, but it's finally catching up to the long-term narrative.
Now, the report also paints Sangdong as a geopolitical trophy in that tungsten war. However, given that commercial production hasn't started quite yet, how much of Almonty's current valuation is running on narrative over fundamentals?
I think for Almonty, it's mostly based on reality. On the one hand, the geopolitical narrative is very compelling. The only large-scale conflict-free tungsten mine outside of China, with the direct alignment to the US and allied defense needs. And that gives Almonty a clear macro story. But it's more than just a concept. The mine is essentially built, the financing is secured, and they have signed real commercial agreements. So the stock market is already reacting, and what we are seeing in the valuation is a market that is pricing in the near-term execution. And based on the current progress, I think that seems justified.
So let's flip over here then. You're forecasting $222 million Canadian in EBITDA by 2027. Yet this quarter's adjusted EBITDA was still deeply negative. So what's the inflection point in your model that flips the story from speculative to cash machine?
Yeah, I think the inflection point is quite clear. It's the switch on of Sangdong. The mine is set to enter production in the second half of 2025 with ramp-up completed by year-end. So that's when we expect the shift from development stage overhead to revenue-generating operations. And also, Sangdong's grades are significantly higher than what we see at Pedasquera in Portugal. So that translates into much stronger production economics. So once the ore starts moving, we anticipate a rapid margin expansion. And the business is transitioning then into a cash machine.
Matthias, let's look at the risk side of that. The $25.8 million non-cash warrant revelation knocked report earnings hard. Is this just IFRS noise or a structural overhang that investors need to factor into their long-term thesis?
Honestly, it's mostly accounting noise, though important to understand. The loss comes from IFRS rules around mark-to-market valuation of outstanding warrants. And because Almonty's share price more than doubled in the quarter, those warrants, which are liabilities on the books, have to revalue it higher. And that's generating a non-cash loss. So it doesn't reflect a business weakness. In fact, it reflects a strength in the stock price. So it's something to be aware of, but it's not a structural issue. So all in all, Almonty is entering a transformational phase. The groundwork has been laid, the financing, the infrastructure, the partnerships, and now we're on the verge of seeing the full impact of the development.
Well, that's a wrap on this episode of Capital Compass. Thank you, Matthias, for going beyond the headline numbers and walking us through the real drivers behind this new 5.50 price target on Almonty. So definitely come back again and give us some more insights soon.
Thank you, Lindsay. And regarding conflicts of interest, please refer to our website, www.gbc-ag.com.
Now, to dig into the full report, check out the link in the article. And of course, to learn more about what Matthias was talking about and GBC as a whole, head to their website again at gbc-ag.de/en. I'm Lindsay Malchuk with Stockhouse Publishing. Thanks for tuning in.